You're such an asshole.
AssholeConsulting.com. Go there if you got questions. And we have a question from young man, woman, Anonymous. Anonymous writes, greetings, Comrade Aaron. Can you answer below the questions via YouTube video? What is the difference between the Chicago and Austrian School of Economics? Had listened to Milton Friedman's videos for a while. Thought he was an Austrian due to the free market stuff, but turns out he was a Chicago. Can you explain in simple terms for dumbasses like me exactly what the difference is? Okay, well, let's answer these one at a time. Man, where did my notes go? There we go. So let's deal with this. This is the biggest question you had, and you decided to fucking make me do economics. That's why I charge extra, because I don't like really fucking working. All right. The general differences between Austrian and Chicago economists is like the difference between socialists and the Democrat Party. There really is no major principle or philosophical differences. The Democrats and the socialists want to enslave you all and take all your money. That's basically it. And the Chicago economists and the Austrian economists are generally for freedom and capitalism and profits and everybody prospering and making lots of money. But there's some philosophical, technical differences between the two. And I'm going to warn you now, every anal retentive, dipshit fucking virgin nerd who is an economist or fashions him or herself as an economist is going to go down in the comments section below and nitpick fucking details because they're purists and the theoreticians. But these are the general differences between a Chicago economist and an Austrian economist, right? One of the main differences is monetary policy. Chicago economists, from a larger general philosophical belief, they believe economics is an actual science, whereas Austrians believe it is a philosophy. So Chicago economists actually believe monetary policy works or has an effect, whereas Austrian economists, they'll admit that monetary policy has an effect, but it's not a functional or useful tool. All you're doing is either creating bubbles by lowering artificial interest rates that should never be set by a central bank in the beginning, or you're printing off money, which causes inflation, whereas Chicago economists kind of subscribe to this, well, the government can do things to intervene. And it's not even that they disagree that a government intervening will have effects. They certainly do agree that. Austrians say, yeah, it causes bubbles. We lower interest rates, it'll create a bubble. We print off money, that'll cause inflation. It's more that it's whether the government should bother intervening in the first fucking place. Not Keynesians, Austrians are perfectly okay with, yeah, let's have great huge recessions. Absolutely. Teach these motherfucking stupid sheeple there are consequences for them borrowing on arms for McMansions they can't afford while they make their $30,000. The Austrians are all about letting the free market hit the shit. Chicagoans are a bit more like, well, what can the government do? What role should the government play? So what can we do with monetary policy? Let's print off money. Let's lower interest rates. So they're very kind of Keynesian in that regard. Now watch the fucking comments. Shut the fuck up. All right. Just took my notes. Another thing that is an assumption is that the Chicago School of Economic Thought assumes that markets are efficient. Not like, okay, the market is the determiner, end-all, be-all of pricing, of value, that millions of people trading and having knowledge ultimately converges in the stock market, the commodities market, whatever market, in the market in general, and these result in a price that people are bidding and lowering, and this amazing mechanism results in price efficiency. And in other words, that a Big Mac really is only worth $3.25 because of its cost and all the stuff that goes into it. And that is typically true. Markets tend to be efficient. But where they defer would be that the Austrians, again on a macroeconomic, a large national level, they say, well, wait a minute. Cash for clunkers, federal home loan assistance, the bailouts, artificially low interest rates, printing off money, this has an effect of creating bubbles and then distorts markets. It distorts prices. Like and a perfect example is the stock. We don't have to go central banking. This has nothing to do with central banking, which is typically what Austrian economists cite as an example of government interference, warping pricing, warping markets. You see that in housing, and you see that, what else? any asset price. But let's take a different example. Let's talk about the stock market. The government, for whatever not for whatever reason, the government altruistically, helpfully wanted to improve people's lives. I don't think that in this particular case it was malicious or mean. And they said we should give Americans an incentive to save for retirement. People aren't saving enough, we should give them incentive. So let's give them a tax deduction if they start investing. And they say, what should they invest in? Now, there's a ton of shit you can invest in. Cattle, your own house, your education, and they just said the stock market. Well, why the stock market or the bond market? Well, because it's liquid. You can go and set up a brokerage account. People will spend money. And I think there may have been a little bit of Wall Street lobbying going on, like, yeah, have them invest with us. We'll take 5% of their money every year. But the larger point is that the government, though well-intentioned, said, let's give tax deductions to people who invest in stocks and bonds through 401ks and IRAs. Well, what has the effect been? Well, now, and there was a study that came out, I wish I could remember, I tried looking it up a bit ago. Some guy came up with a study and showed that up until about 20, 30 years ago, the stock market was largely driven by the profits of the underlying companies, the profits and dividends of the stocks. Well, that makes fucking sense, because that's the only reason you invest in a stock. Today, for the past 20 or 30 years, it's been driven by the amount of credit, by the amount of loans, low interest rates, money being printed off, etc., etc. And that is what's been driving the market. So in other words, a stock price can go down, a company's profits can go down, but its stock price can still go up because there's that much more money flooding the market, because there's that many 401ks, IRA dollars flooding the market. Mindless, mind you. Mindless zombie dollars. No one analyzes stocks anymore. No one looks at it. It's just like, I want to invest in my 401k because the HR lady said I should. I want to invest. Well, I'm investing. I contribute to my 401k. Hello. To quote Tim Allen. But they're not looking at the underlying fundamentals of the investment. They're not looking at the profits. No one when's the last time you bought a stock and looked at its profits? Did you? Did you look at the dividends? No, it's just, I think I should invest in a 401k because the guy over at Edward Jones said I should. So this creates a bubble, and now we have dividend yields. You're only making 2% off of stocks. I'm not talking capital gains. If you don't know the difference, that's too bad for fucking you. Go look that shit up. It's very important. But right now, you're only making 2% a year off of dividends. Stocks only generate profits of 2% a year in dividends. That's barely inflation, dude. So there really is no value. Stocks should technically be trading at zero right now. If inflation is 2% and you're going to pay me 2%, why the fuck would we exchange money? So this is a critique or a belief that the Austrians believe is that government policy, typically in the central bank, but not always, sometimes in the case of retirement planning, giving a tax break to 401ks, IRAs, will distort markets, and now when you distort markets, you don't know what the real price is anymore. Chicagoans believe that the market is always right, this is the price, there's no possibility for a bubble, although they do admit there is a possibility. So I'm just giving you a general black and white kind of definition. There's many shades of gray here. The third one. The third one is what I kind of referenced to before, and that is the Chicagoans typically believe economics to be a science, that we could come up with models and programs, that we could do multivariable regression, do Harry Markowitz efficient frontier analysis, and it's all going to work out just like fucking STEM, or Kepler's laws of physics, or Newtonian laws of physics. It's not. And that's not an opinion. Economics is not that. Austrians acknowledge this. The Austrians at least acknowledge that economics is a philosophy, and that all of economics is derived through human action, through human psychology, which is volatile and changes. All you were willing to pay $500,000 for a McMansion in 2005, now you're not. So the Austrians are basically, they know their limitations. They know that this is not a science, that there are some general principles and theories we can pull from it, but it is a fluid and dynamic and changing environment, and they go based more on principles. Humans should be free. You should have low taxes. Not because there's any economic empirical data that currently proves it or not. That has nothing to do with it. It's like, no, you should be free. And not only free to make a ton of money, you should be free to fail. This is why they're totally against TARP bailouts and bailing out corporations and bailing out the banks. Now, Chicago economists, they're not for bailing out banks either. I mean, it's the underlying assumption that, well, there's a science here. There's a science and a philosophy. And Keynesians, oh my God, they can't bend over. Keynesians go, I don't know if you knew this. Let me tell you a little bit about Keynesians, which is different from Chicago. And Keynesians so believe that economics is a science. They really do believe, and they'd like to fashion themselves as engineers or STEM, but they're just not that smart. Keynesians at university, they will go to the medical school and they have this surgery made where they take out a vertebrae and they put in a wench, or what do you call it? They basically replace one of the vertebrae with a metal cylinder that allows them to bend so far over they can actually suck their own dick and think they're that good. Like economics is a real science. I mean, they can go full throat down on their own dicks, Keynesians can, because that's how enamored with themselves and economics they are. So in a general spectrum, Keynesians actually think they're real scientists. They really do believe it. I mean, Krugman, Reich, these guys actually think that economics is not dynamic, it's not changing. They believe that it's a science. And again, they had that surgery where they can full throat, sometimes choke themselves out on their own dicks. Chicago economists, they say, well, we think this is a science. We think this is a science, but they don't get the surgery to suck their own dicks. And Austria's like, fuck all of you both. This is not a science. This is a philosophy. This is changing. We have no hard and fast rules here. We have principles by which we should advocate freedom for people. And so that's kind of the main differences. So I guess that answered that. So the second question, during the 2008 recession prior to the rise of silver and gold prices, the price initially fell. It fell from around 20 to about 10 to 50% drop, then proceeded to rise to 40. From what I read online, one reason this occurred because many folks, traders, sold to cover their stock losses during the time. Is this actually true? Yes, people do borrow against, well, everything, not just commodities, but you look at the derivatives markets, it's all borrowing against the up or down of a particular swing in the price of any investment, commodity, stock, bond, whatever it is. So that is certainly that, and there is that effect going on there. If there's another crash, what were other factors involved as well? About the only one I could say that the other factor that would be involved would be silver is actually used as an industrial metal, cell phones, other things, computers, stuff like that. So when the economy slowed down, obviously there would be a drop in demand for silver for functional manufacturing reasons, not just you, me, and investing for insurance reasons. So there was that factor as well. But yeah, it went down because people were trying to cover their short positions. But then there was a little bit of, not as much I'd suggest, because the material, the construction, the industrial demand for silver went down as well. If there's another crash, can we expect a similar scenario situation again wherein price falls first before rising again? Please see the attached. I don't know. I really don't know. I'd like to think that the market would learn from its mistakes and then silver would just go up. That would indicate some kind of progress in human psychology and intelligence. But I don't believe, I think based on looking at leverage ratios and the derivatives markets, you're going to see the exact same things. If people are going to sell to cover their short positions. The industrial demand will go down. You got to understand that people in Wall Street and the trading, they're Keynesians. They're sucking their own dicks. Their foresight only goes about here. Chicago economists might get here. Austrians would be up here. So I would almost wait for the dip. Wait for that dip because they never thought, well, wait a minute, silver is also precious metal. I mean, fucking Warren Buffett will, precious metals is not a gentleman's investment. It's like, okay, fine. You're right. It ain't an investment. It doesn't pay dividends. But you know what? When the economy collapses, I want to have some gold and silver. So you can always rely on the stupidity of Americans. You can always rely on the stupidity of Wall Street. You can always rely on the stupidity of people in finance and banking. They are not that bright. They are that dumb, and they're not that long thinking. And they are hubristic enough to leverage against silver or gold or anything else. So yeah, I can't guarantee anything because I'm a real economist, but I would almost guarantee you that there would be a drop down. You could buy more, but why risk that? Buy silver now. If you like silver, go ahead, buy it, and then buy some more if it happens to go down because people are trying to cover their short positions. Why the fuck not? Leave a little bit of powder, dry powder in your keg. I'm thinking of opening an IRA account. I'm 30 years old. Do you think it's worth having an IRA? Is there a chance the government may confiscate, at least in part, money from IRAs for OKs in the future? I feel Social Security dependence is not a wise idea. What is your view on IRAs? Also generated 2 cents. Fuck, yes. All right, traditional and Roth. Fuck, God almighty, I totally undercharged you. The IRAs, if you got nothing else to do with your money, like, there's so much other shit you can do with your money. Pay off your debts. Pay off your mortgage. Go to school to get a real skill, like, get really good certifications that increase your wage. And even nowadays, if you're concerned about the government confiscating your IRAs, I would only use IRAs and 401ks, the traditional ones, to lower your tax bill. The Roth IRAs, gosh almighty, that's a tough one. I really don't know, because there's so many things the government could do. They could just outright confiscate it. They could rescind the tax treatment, say, well, we know we said that we were never going to tax you, but we're going to tax you now. Or they could just leave it alone and actually honor it. But there was even talk in 2008, the Democrats were eyeing retirement accounts. We've seen this happen in Argentina. We've seen it happen in Bulgaria and Poland. We also saw it, obviously, in Cyprus. And I think Greece even did a little bit of confiscation. I'm really reluctant to start just throwing money into an IRA or a 401k, Roth or traditional, unless, the traditional, okay, at least you get your tax deduction. But I'm sorry, in my personal life, I have way too many investments to pay way higher rate of return that more than compensates for the risk involved and for confiscation, not to mention general stock market risk. But also the rates of return in the stock market are shit. I get real dividends. I wrote a post why I'd rather invest in Davis Arenia than a 401k. I paid Davis Arenia $1,000 to read my book and turn it into an audiobook. And I make about 70% a year off of that. Do you have a 70% rate of return? So I think I would rather, if you want to be really safe and have something under your control and the government can't take, not take as quickly, I'd be looking at entrepreneurship or peer-to-peer lending, like Peerformance or Prosper. You eke out a couple extra percentage points there, but yeah, man, those 401ks, IRAs, I'd shore up your personal finances first before you start throwing money. If you have nothing else to do with your money, then you could go ahead and throw it in. Gold IRAs, my opinion on gold IRAs, no, you don't own it. If you don't hold it, you don't own it, okay? If you want to get into precious metals, buy fucking precious metals, right? Get the silver bullion, get the gold coins, and you own it. That way when you're investing in silver and gold in case the economy collapses. And if the economy collapses, that means your electricity isn't running, your internet isn't running, and you can't go online to sell your fucking ETF or index fund in gold. So you either buy gold or silver or you don't. Don't fucking dick around with this, oh, I got a gold IRA. No, you don't. Do you do gun reviews? No need to have this. Yeah, but you're going to pay me extra for that because this has gone already way too damn long. And I'm not a gun expert. I know what I like, and if you want to pay for that opinion, you certainly can. Oh, shit! Can you wear the commie hat? Yeah, of course I can wear the commie hat. Fuck, I can do that. Jesus Christ. Our good friend Glorious Carl at glorioushat.com. Go to glorioushat.com. You can get yourself a glorious hat like this right here. Fucking hell. I'll put that on right there. Glorious Hat. My buddy Glorious Carl. He's got these hats. I don't have any of the placards. Placards. Do I have any of the placards? My desk is a fucking mess. Never trust anybody with a clean desk. That means they're not working. And I'm not fucking bullshitting on that. I don't know where it went. God damn it, am I out of placards? They're somewhere. I'm sorry, Glorious Carl. They're not here. Anyway, I hope we all learned something, we answered something, and we answered your question about Austrian and Chicago economists. Hope that helps out, and for fuck's sake, please buy precious metals physically. Don't fucking invest them in paper. Toodles.